Because if the company isn't profitable, then you're owning something that is worthless, you feel me? So we already own enough liabilities because we own cars and we own clothes. The news is always saying NVIDIA is the first $5 trillion market. Well, technology stocks expand the GDP the most, so a lot of technology stocks have the biggest market cap. Private companies help you diversify. Diversify is on this list. A dividend yield, this is where the real money comes in. So DRIP is a dividend reinvestment plan. A DRIP, everyone needs DRIP activated on. You need DRIP in the real world, you need DRIP in the stock market. DRIP gonna automatically help you dollar cost average, but then with your paycheck, you also have the dollar cost average. If real estate has less buyers, it's less liquid. Private equity is less liquid. This book will teach you a lot about diversification. What is good, YouTube? Disciplined Diamond Hands back with another video. I'm glad to be back, man. Why am I glad to be back? Because I get to help y'all learn how to build wealth passively. There's no physical labor needed, and there's no cap on salary, and it erases the wealth cap. Today what I'm going to do is I'm going to go over a video that covers the top 10 definitions for beginner investors, and I'm going to show y'all practical ways on how you can use these definitions to actually make money. Every definition I'm going to cover for at least a minute. I'm going to break down and show you how it works, and I'm going to go into depth on how to use it on the screen and on the chart. First thing first, I'm not a financial advisor, but I do have disciplined diamond hands. The first definition we have is stock. What is a stock? A stock is proof of ownership. You own a fractional percentage of a company, the company that issued it. Companies issue shares to raise money to operate or expand their business. An investor benefit when a company grows and make money. So that's why you want to be investing in profitable companies, because if the company isn't profitable, then you're owning something that is worthless, you feel me? So no one wants to own anything that is worthless. So boom, we own profitable companies. What companies are profitable? Well, a lot of companies are profitable. This is one of the great indexes to own, the SPX index, because it holds the top 500 public traded companies. And the top 500 public traded companies, most of them are profitable and most of them are growing in their revenue. So if you're owning something, you want to own something that has a revenue and that's growing bigger and bigger and bigger. You don't want to hold something that's decreasing, because then it's a liability. We already own enough liabilities because we own cars and we own clothes and we own a lot of things that are losing in value. So when you buy a stock, you want to make sure you're buying the stock and you're buying ownership in a company that is profitable. Market capitalization. Market capitalization shows how much a company is worth as determined by the total market value of all outstanding shares. So listen, man, the news is always saying NVIDIA is the first $5 trillion market cap company or $4 trillion market cap company. How do you measure a market cap? What does market cap even mean? Well, check this out right here. The market cap is calculated by the shares that are outstanding times the price of the shares. So if we look at NVIDIA right here, the shares outstanding is 24.3 billion. So if we type that in, boom, multiply that by their share price, which is $190.17. Boom, we get the market cap. We see how NVIDIA is the biggest company. Why is NVIDIA the biggest company? Well, technology stocks expand the GDP the most. So a lot of technology stocks have the biggest market cap. Then I think we have like Apple behind them, Meta's right here, 1.4 trillion. The more valuable the company's share price is and the more shares they have outstanding, the higher their market cap will be. An exchange traded fund is a basket of securities that trades on an exchange just like a stock. One of the best ETF is the ETF that follows the SPX index. Why? Because an ETF that follows the SPX index holds the top 500 public companies. And the top 500 public companies are NVIDIA, which is the biggest company in the world. Then you got Apple, which is the next biggest behind them. Check these out. The biggest companies in the world are held in the SPX index. And if you invest in an ETF that holds these companies, then you'll be diversified, which is a definition we got on this list. And you'll own profitable big companies that are growing. So just like the first definition said, you want to have ownership. You'll have ownership in a company by buying a stock. So the ownership you do want to have is ownership in public, profitable, growing companies. I wouldn't say public because I own some private companies. Private companies help you diversify. Diversify is on this list. We're gonna go over that next, but the companies in the SPX index or in the ETFs that have companies in this index have NVIDIA, Apple, Microsoft, Google, Amazon, Meta, Tesla, Berkshire Hathaway, JP Morgan, Eli Lilly, Walmart, Visa, MasterCard, Johnson & Johnson, Netflix, Costco, Bank of America, Home Depot, Procter & Gamble, Coca-Cola, United Health Group, all these companies, Wells Fargo, McDonald's on this list, all of these companies are profitable and growing in revenue. So when you buy an ETF, you're investing in a fund that holds all of these companies, and all of these companies are definitely growing. A broker is an individual or firm that acts as an intermediary between an investor and security exchanges. What are brokers? It's a lot of brokers out there. These are some that I use. We got Robinhood, we got Fidelity, we got Charles Schwab, we got Interactive Brokers, we got Cash App. It's a lot of them. You got Fundrise. My favorite one is Robinhood, and Robinhood is growing. And I say my second favorite one is Interactive Brokers. I mean, the easiest broker is Cash App, because I mean, a lot of people have Cash App. So those are some of the brokers, but it's over 1,000 brokers. But you want to make sure the broker you're using is backed by the U.S. government, and it's in the U.S., because a lot of offshore brokers, I mean, they can steal your money and they overseas. So what you gonna do to get it back, you know? The next definition we have are exchanges. Exchanges are marketplaces for the trade of securities, commodities, derivatives, and other financial instruments. We got the New York Stock Exchange, we got NASDAQ, we got the London Stock Exchange, we got Tokyo Stock Exchange, we got Chicago Board of Exchange, we got a lot of multiple exchanges. Each exchange has its own rules for a company to be listed on the exchange. The London Stock Exchange is obviously in London. Then you got Tokyo, you got Chicago, you got New York. You got multiple different exchanges for multiple different countries and different territories and areas. You might hear, oh, this company is listed on the New York Stock Exchange. If it's listed on the New York Stock Exchange, that's just the marketplace. It's listed on a dividend yield. This is one of my favorite. This where the real money comes in at. So a dividend yield is a financial ratio showing the return an investor will earn from an investment based solely on its dividend payments. You must own shares before the ex-dividend date for a payout. So let's go over my favorite dividend stock right now, UPS. I got in UPS at $92. Obviously they're at 96 right now, which is great. I got one dividend in UPS right now. Their ex-dividend date is tomorrow. So hey, if y'all don't own them, y'all ain't getting this dividend. But check this out. Their dividend yield is right here. Their dividend yield is 6.83%. What does 6.83% mean? Well, for every dollar you invest, they'll pay you 6.83% of that dollar just for owning their stock. What's great about dividend companies is they'll pay you dividends and as well as share price appreciation. So let's check this out. If you was to invest $1,000 in UPS, we're not talking about stock appreciation. We're just talking about what they would pay you in dividends per year. It would be 6 times 83%, which totals up to $68.30. So they're paying you $68.30 just for investing in their company. Well, what dividends show you? Dividends tell you that this company is profitable and is stable and is growing over time, is making enough profits to pay back its shareholders and continuously grow the business. So dividends are great for long-term investors, for compound growth. And a lot of younger people say, oh, I don't like dividend stocks because I like growth stocks, which is true. Growth stocks are higher risk, but it's more growth. But UPS is so undervalued at the level it's at now, and it pays dividends. I couldn't miss out on it. A drip, everyone needs drip activated on. You need drip. You need drip in the real world. You need drip in the stock market. What is drip? DRIP is a dividend reinvestment plan through which cash dividends are reinvested to buy more stocks. So if you have DRIP activated, every time it pays you a dividend, it automatically rebuys more shares. So it's easier for you to compound, and it's easier for you to dollar cost average. What does dollar cost average mean? Dollar cost average is intended to average the price at which you buy stocks as it moves up or down. So dollar cost average means you have a consistent rate at which you invest your dollars into a company. So a lot of people dollar cost average with their weekly paycheck or monthly paycheck. Every week I'll invest 10 bucks. Every week or every month I'll invest 20 bucks. Despite whether it goes up or down, you're averaging in. My portfolio, I always dollar cost average within that portfolio, whether it's up or down. And dollar cost average, it just compounds over time. It helps you. So if you have drip activated, that drip gonna automatically help you dollar cost average. But then with your paycheck, you also have the dollar cost average. And it only takes $1, but $5, $10, $20 is great. The more the better. The less the better as well, because everybody ain't got more, Liquidity refers to the ease with an asset or security that can be converted into ready cash without affecting its market price. High liquidity means it's easy to get in and out. Few buyers and sellers mean you will be stuck and you may have to sell it for low. So let's check it out. What are some asset classes that have high liquidity? Well, NVIDIA has high liquidity, the biggest stock on the stock market. It has high liquidity because there's always buyers and sellers. You can sell it at the market price without having to lower the price because it's not a lot of buyers. If real estate has less buyers, it's less liquid. Private equity is less liquid. It's harder to sell assets that are less liquid because you can't convert it into readily cash. Like cars, it's harder to convert a car into cash versus converting NVIDIA into cash. I can convert NVIDIA into cash in 1 second. Everyone can by selling the button, but we all can't convert a house or a car or clothes or jewelry into cash in 1 second the same way NVIDIA could. Or penny stocks, it might be hard to convert a penny stock into cash. Some assets is good for them to be illiquid because think about it, human beings as us, if it's easier to sell, we might make the wrong mistake of selling something that's easy to sell just because it's easy to sell when we should hold it long term, like NVIDIA stock. Like I sold NVIDIA stock maybe a couple months ago, but if it was harder to sell, like my private equity or my venture capital fund that I'm invested in, if it was hard to sell, I can't really touch that. I just have to let it sit and grow. Like my private credit and venture fund, I'm just letting it sit and letting it grow because they sell their shares like every 3 months. So it's like, I can't really even touch that if I wanted to, or if I did, I have to wait a couple months. So the more illiquid it is, the less money I put in it as of right now. But volatility represents how greatly an asset price swings around the mean price. Okay, look, check this out. We all hear crypto. Crypto is more volatile, which is true, because let's check it out, man. Crypto swings are, look at this swing right here. We can already see this swing is big. Look at this swing right here. This swing is big as well. Like, let's measure these swings real fast, right? And then I'm gonna show y'all what something that has less volatility do. So let's do, I guess, from the bottom of 2023 up to this. Look, it went up over 400%. Not saying high volatility is bad or good. I'm just saying volatility is volatility. Volatility means it moves fast. So look, check this out. Bitcoin moved 400% since 2023, that dip right there. And then we can check out the SPX since 2023. Really, we're just gonna check it out from 2022. It moved under 100%. So if we go back to volatility and see what volatility means, it means how great an asset price swings around the mean price. The SPX stay closer to the mean price than cryptos. But yeah, I love cryptos too because, hey man, you gotta stay diversified as possible. If you can stay diversified as possible, do it. You know what I'm saying? Or that's what I do, I ain't gonna lie. Diversification is a strategy that mixes a wide variety of investments within one portfolio. Diversification means if stocks go down, my venture capital fund not going down. If the real estate market go down, my private credit fund won't go down. If gold go down, my sport team investments won't go down. Volatility means holding different assets that don't follow each other or that are uncorrelated. Like in Tony Robbins' book right here, I've been reading this book. It's a great book. This book will teach you a lot about diversification right here. This book is the reason why I started diversifying into venture capital, private credit, private equity, just because diversification is important. Because if the stock market crashed today, I don't really care, because I got the venture fund, I got private credit, I got private equity, I got a real estate fund, I got so many other funds that'll keep growing if the stock market crash, just because I'm diversified. And then when the stock market do crash, it doesn't mean you run away. It just means, okay, now I get to analyze more assets at the undervalued price. So if I buy them now, I'll just make more once they return back up. Because as we can look and check out the SPX index right here that hold the top 500 public companies, despite every crash, it always recovers. So due to the president inauguration, the president making the market crash a lot, it always gonna recover. Inflation always goes up. The market is always going to outpace inflation and always give you a return on your money, despite how bad inflation is. Despite the pandemic, the market is going to recover. Oil prices uncertainty, trade tension, the global financial crisis, the dot-com crash. Despite all these crashes, the stock market will always increase in value. And also diversification is very important, because you don't want to get caught holding the bag that's going down in value when there are other asset classes to invest in as well to continuously increase your net worth.